Hello and welcome to today's video, which is being recorded an hour before PPI announcement, and it's called PPI. Shall we go one more time? Of course I'm referring to equities and the kind of an initial bullish reaction that I expected to play out yesterday and which was the one to capitalize on in intraday terms, followed with a lot of whipsaws. So let's see whether markets favor having us prepared the same fate today or not exactly. Let's dive right into the charts. This was the situation before CPI release and markets were positioning for an upside reaction. I have been covering that in yesterday's video, to which I will be linking. Thank you for liking these videos and subscribing to the channel with notifications on, because you do want to be notified whenever new content goes up right away to take maximum advantage of it. This is right now how S&P 500 is looking on the hourly chart. We see that the kind of horizontal support represented by the 5,555 to say 65 area held, and that's where it was opportune to initiate long positions that clients are riding, whether they are swing or intraday. The intraday ones had already cashed out, but the swing ones not yet, and it tells you what kind of a play is the one that I expect, but following PPI, but of course is the open trade management that matters the most. Whether we see a breakdown or not, what do volatility, yields, US dollar, cryptos tell us, and there are quite a few clues, out of which I will present a few, painting the necessary picture for you. Did you get the clue from yesterday's video? If not, I suggest you review that. I'm running still an interesting poll asking clients or followers whether we are seeing a tweezer bottom being formed on S&P 500 daily or a bear flag. The results are pre-displayed, reflecting the current uncertainty. However, I lean slightly more one way. So, shall we get a more successful day on PPI, meaning a smoother ride in equities, less trappy one? Nvidia, Tesla, MicroStrategy, they had been painting a really interesting signs if you consider their daily charts, volumes, candlesticks. Is it kind of a counter-trend play or budding turnaround? This message is kind of clear if you examine market breadth indicators. I will not do that in here, but clients are in the picture of what they think where we are headed in equities in the days and weeks ahead. Let's dive into this sectoral overview, where I had been calling for tech outperformance yesterday, and that was clearly what we had seen during the regular session as well. What will be most vulnerable today and what did benefit yesterday of very beaten down levels? It were discretionaries. So it's up to a decent PPI reading to confirm that message and allow for discretionaries, which are kind of holding the clues, holding the keys even more now than financials, lackluster financials, the former leader who had rolled over and is just kind of going sideways, including the biggest names. So there might be more downside, but let's see when and how, what would be the path leading there, if any. This is what awaits PPI, and just as I had called for low CPI yesterday, be it headline, be it core, be it month on month, be it yearly. This is kind of mirrored in the PPI message, because if you examine the run-up when the tariff planning was kind of starting months ago, the situation had calmed down. Now the headlines and negotiations and countermeasures and their recall and their resurfacing and everything is coming on and off. However, those inflation metrics are not in as a panicky state as they had been, say, 3 or 2 months ago, which is kind of constructive. On the other hand, it kind of mirrors as well the stagflationary wave of data that started to arrive, not the preceding, but the one before Friday. And right below, forget not about unemployment claims. Watch where not the initial ones are, but the continuing ones. This picture of the job market is slowly deteriorating. However, it is not on the front burner just yet. So it's good to look at the delinquencies and whenever cars are repossessed, what is the recovery rate and so on. That is all fine and dandy. However, don't conflate that with the full job market picture, which is not yet at that stage of gloom. Definitely not, and the unemployment rate still reflects that. Of course, dropping out of the workforce, the participation rate, that paints a different picture and dials back the message of what I had just said. However, the takeaway is the same. It's not on the front burner, and only readings, initial ones, over 250, the psychological level, and continuing claims rising by not just 5% week per week, but say 10%. That would be what would spell trouble. However, where we are going to see in consumer discretionary. So this is the key sector that I will be watching today. It is the one that can sensitively react to an upside or downside surprise in PPI, and I do expect relatively tame PPI and equities to do one big oof. It's behind us, it's not been disastrous. I do think that we can come at 0.3% headline, maybe the core as well, which would be in line, positive, and the kind of short-term improvement in market breadth can proceed, as I at least hinted at via mentioning those 3 tickers. Forget not about gold, where I had been calling for initial stumble yesterday on CPI, and just on the hourly candle, seeing how it is being retraced, it was clear that gold is going to be running again without any kind of an interruption. So Trading Sigma's clients got it right on gold, got it right on silver, where I had been forecasting more than a budding outperformance to come. And the same goes for oil, where I had called for a respite, not it's taking out 69, definitely not. However, a respite in selling with a modest retracement of the prior decline, but not at all surpassing 69 or let alone 70 level. The conditions are not right for that at the moment. Finally, let's dive into the volatility picture, where we kind of see yesterday's closing prices breaking the more than 45 degrees angle steep ascent. Is it the first sign? More to come? You know that I like to specify this picture to make it more precise by comparing it to forward-looking volatility, and there we see more action within the full scope, including upper knots of prior candles, and there is some kind of a rejection. And what is the key takeaway? We seek to be riding greater chunks of a move going one way. So here, does it look to you that we are on the immediate doorstep of surging higher in this ratio out of the range given that what you had seen in VIX? Not exactly. I think that we are being positioned for a short-term reprieve, which would coincide with the return in risk appetite and slightly better US dollar prices, meaning the index going up through the 105 level, which are the things that I had covered in preceding videos. So make sure that you are subscribed to the channel, have notifications on, and set off a few minutes of your precious time every single day to review what I want to share with you to be ready for the trading day ahead. So thank you for liking this video. My joint page is helping you select what's right for you based on what and how you trade. I can't stress enough the importance of having access to real-time commentaries coupled with full scope daily analytics, so that you understand not just the turning points, but what leads to them, what I watch, and how I see the greater path beyond a couple of hours ahead in various assets.